Hello, everybody. Thanks for tuning in. My name is Kenny. I am the founder and CEO of STR Insights. I am super excited to introduce and have a great discussion with Brian Bockholdt with the Bockholdt lending team. So Brian is one of our partners, he's our lending partner on STR Insights. He's got some great products. We're going to talk about the products that he offers. We're going to talk about just lending in general in 2023 because things have changed. And to kind of, before I really introduce him and bring him in, I want to share just the dynamic of how much things have changed from 2022 to 2023 because of the rise of interest rates. I purchased a property last year at almost the middle of 2022. And I was using a DSCR loan product. Interest rates were starting to definitely rise up. I got in at around like 6%, which is still pretty high. But I was able to get that product, and I've seen those rates shoot higher and higher and higher, and they've really become not as attractive as what they were last year, especially in 2021. And so, what options are out there? Is it still, because really the interest rates are making or breaking deals. I've seen a lot of people, I found this great property. We're flexible. The seller is able to lower the price, and then they go and they look at the interest rates and they look at how much they're going to pay for their mortgage every month. And it kills the deal and there's no cash flow. So what do we do? What options do we have? This is where Brian's going to come in. So just so everybody knows about Brian, he's with Bockholdt lending team. Brian also owns short-term rentals as well. He owns 4 short-term rentals. He's been doing loans and mortgage originations for over, many, many years. I'll just say several decades. And he is he's one of the top 1% originators nationally. So this guy knows his stuff. We're super excited to have him. I'm trying to find a property so I can work with him on a deal, but I have several other clients, friends, other investors I personally know who use him and recommend him. So without further ado, I'm going to bring in Brian. Springs here. How you doing, Brian?
I'm doing great, Kenny. How are you?
Good. So thanks for joining, Brian. We're excited to have you. Let's talk lending. Let's talk products. So, Brian, I know you kind of have like this flagship one product that a lot of STR investors are using this year. What is that product, and can you just tell us about it?
Sure. As you may know, and many have come to find out recently, the 10% down second home loan by Fannie Mae, which was very popular for a long time. There were some changes made just a little shy of a year ago. I think it might have been like in March of 2022 or so. And Fannie Mae and Freddie Mac rolled out some pretty significant loan level pricing adjustments for second homes and really changed the game. They basically started treating second homes like investment properties, kind of aware of the movement, of the kind of things that with the Airbnb and the VRBO, Fannie, in my opinion, but they made some significant changes. Right now, if you're going to get a Fannie Mae 10% down second home loan, you're probably paying 3 or 4 points. That's been a real barrier of entry for a lot of people. I mean, if you're buying if you're borrowing $600,000, you're looking at around $20,000 in additional origination fees. And you mentioned earlier how while rates rise, it gets a little harder to pencil out these deals for people, and throwing an extra 20 grand right off the top and doesn't make it any easier. So the most attractive part of our product is that there are no points. So it's a 10% down program. We can do jumbo as well. Jumbo is technically 15% down, but we get approvals to do 10% down on jumbo all the time, probably 80% of the time. The interest rates are comparable, if not better, than the Fannie Mae rates. And probably most importantly, you're looking at no points. So you're saving that 20 grand right off the top.
That's great. So let's give you popular types of investors, short-term rental investors that you probably deal with. So the one avatar we'll say is someone with the W-2 job. They're trying to get this loan. Obviously, you want to talk about DTI here, but what are some of the requirements that you're really looking for, in terms of tax returns, what the length of the period of time people need to have tax returns? Like, how can I be, as a W-2 income earner, prepared, and what information do you need for these type of the loan requirements?
Sure. So we're doing a standard debt to income ratio calculation. We're not doing, DSCR. We don't care about the projected income from the subject property. If it's going to be used as a short-term rental, we can't count that. We can count that in the future. So as soon as that hits a tax return, the following year, we can use that short-term rental income, but we cannot use it to qualify for that particular property. So we're going to calculate debt ratio normal. Self-employed is fine. Obviously can be, sometimes be more challenging. Typically we need 2 years history for self-employed income. We can, and just did it again recently, on occasion, get an exception to use 1 year's tax return if it's a new business. And the rest of the file is really strong. So we did that recently for a couple people. But otherwise, 2-year income history, standard debt ratio 3, but I can get it done in the mid to upper 40s. And that's about it.
Okay. So when you said you can use income from potential, okay, well, I guess we'll dive into this one a little more. Can you use previous? So if I have a short-term rental right now that's generating income, you said you can use, based off my previous tax returns, how much income that property's generated as part of the DTI, correct?
That's correct. As long as it's on a tax return, we can use it. So if you bought an STR, in May of 2022, and you haven't yet filed your 22s, we can't use your, transaction histories, your VRBO receipts or whatever. But once you file your 2022s, we can use that. And we're adding back in, so many people are obviously doing the cost segs right away, and depreciate, have huge depreciation numbers, but we're always adding back in depreciation. So along with other things like mortgage interest and taxes and homeowners insurance. So even if you're doing a cost seg, we can still use that.
Anyone listening, that's huge. So, Brian, maybe you could speak more to that, but in my experience, when I was talking to, especially some local lenders, a lot of them don't take into account that those tax strategies that investors, short-term rental investors, can utilize, and they don't, because they don't understand them. And they, so that I think that's a big advantage there. I don't know if you want to add anything to that, Brian.
Well, it is. Certainly, if you're dealing with a lender who can't add back in the depreciation, and you did a cost seg, you're probably sunk, right? Depreciating a couple $100,000 or whatever, that's probably going to mess up your DTI pretty severely. So, definitely a big help to be able to add back in the depreciation, even if it's not cost seg, just standard depreciation year over year, to be able to add that back in is helpful.
Gotcha. What type of questions would you so from let's put you in the shoes of an investor, not a lender. When you're talking to a lender about these different products, what kind of questions should you be, like qualifying questions, should you be asking your lender to make sure they know how to do certain things? Not necessarily about the depreciation, solely the depreciation, but any other type of qualifiers, I guess.
That's a good question. It's most of them out there are probably going to be peddling you the Fannie Mae 10% down second home loan.
Right.
So it's, as far as what they're looking for, it's going to look a lot like what I'm looking for, right? The requirements are not necessarily that different, right? The debt ratio has got to be somewhere under feet. Credit requirements. I think we need 720 credit score. We can do lower with an exception. But But all those things are going to run pretty parallel. Reserves, you need to have a little extra money in the bank for reserves when you buy a second home or an investment property. But the real difference is the product itself, where, again, you're paying 3 or 4 points versus our product where you're not paying anything. So, I guess to try to better answer the things that they need to ask, they just need to understand the down payment requirements, the debt ratio, what kind of income they can use. If they're self-employed, really dig into that and ask some questions around that. But it's pretty cookie cutter because, again, it's the standard Fannie Mae product, and it's pretty much what everybody else has out there right now, unless you're going DSCR.
Yeah, for sure. Okay, that makes sense. Now let's talk about self-employed individuals or entrepreneurs. What do they need to know in order to, be prepared to have a conversation? What do they need to bring you to the table, like information they need to basically, have this type of product?
Well, first and foremost, ownership percentage. So if you own less than 25, so let's say you're W-2'd employee, and often, people W-2 themselves even when they're 100% owner of the company. But if you're a W-2'd employee and you own less than 25% of a business, we don't even have to classify you as self-employed. Okay. W-2'd income, if that's more favorable. If you do own 25% or more, then you then are technically self-employed. We will need 2 years tax returns. It's important. Whenever I get on the phone with a self-employed client, the first thing I want to do, I want their tax returns in my hand, like right away, because a lot of times people think, some of us have a better understanding than others, and they know they grossed, big money, 600,000, 800,000 or whatever last year. But they don't really maybe understand how good their accountant was. And, they didn't, at the end of the day, didn't quite make on paper what they needed to make. So, it's important to get out ahead of that, get those tax returns in so they can be analyzed. We always send them in right away and get them analyzed by an underwriter so that we know, like, even before, at the time of pre-approval. So before they're under contract, we know exactly what income we can use. So that's really important.
Okay. So you mentioned 2-year tax returns. I'm going to throw you a scenario here. This isn't necessarily me, but let's pretend it's me. I started my business. I have 1-year tax return, and my business is doing really well. Maybe it's a short-term rental business, and I've gone off my W-2 and I'm strictly short-term rental or property management per se. Is there anything you can do for me, or what do you recommend?
Okay. Well, one thing that you mentioned something that triggered something I want to make sure I don't forget to mention, because I had someone ask me this yesterday. While we do need 2 years tax returns per guidelines anyways for a self-employed borrower, if we're talking about short-term rental income, so let's say you bought that short-term rental in 2022 early on, you had a good year, and in a couple months when your 2022s are filed, we can use that right away. So we don't need a 2-year history of the short-term rental or any other rental income for that matter. Okay, so that's a pretty big deal. As people are trying to scale, a lot of times they'll run out of DTI, right? Because they bought a couple STRs, but then once they get a year's worth of on those STRs and they get that on a tax return the following year, they may now be back to qualifying again. So yeah, we don't need a 2-year history when it comes to the rental income. For normal self-employment income, we do, like I mentioned, if the file is really strong, the borrower is really strong, good assets, the first year of business, the income was excellent. They're maybe putting down a good down payment, credit scores are high. We can sometimes get the exception to do just 1 year worth of tax returns for self-employed. But again, that's definitely case by case.
Sure. Here's a really specific instance, and this is more for my curiosity as well. How do you work with individuals who have some sort of layering of their short-term rental property? So an LLC within a holdings company, or another LLC that kind of owns multiple of these properties. Do you need separate business returns from each property in order to work, or can you kind of work with that one holdings company tax return?
So typically we're going to want all returns. So
Okay.
if typically we're going to want all of the returns. We are able, since you brought up LLC, we are able to close in an LLC when we purchase these. And if we're doing 15% down or more, we can close in an LLC. They don't allow it at 10% down. And this is taking title in the name of the LLC, not the mortgage itself.
Right. Okay. That makes
A lot of
sense.
people get the two things confused. Yeah.
Right. That's good to know. Yeah. And for people listening, that might be a huge factor, especially with a lot of cities or communities enacting some sort of regulation in the market. So this happened to me last year. I wanted to purchase a property, but I needed the permit in the name of the LLC, but the LLC had to own the actual property, had to be on the title. So that actually limited what type of loan products I could get at that time, and or banks I could work with. So these are things that people need, you need to think about before you just pull the trigger on a product, is saying like, here's my situation. And that's why I think Brian's a great guy to work with, because he understands these things. Me asking this, it kind of triggered, hey, you need to know this. And so that's definitely helpful. Let's see, what else, Brian? What about, so Amanda here asked about bank statements. So I'm self-employed. This is this is a great question. I'm self-employed, and can you use bank statements, or is it just tax returns?
Yeah, it is just tax returns. There are somewhere out there some bank statement programs that other lenders are offering. I don't know if they're offering them on second homes. And anytime you run into that kind of a product, the terms start to change greatly, right? So the more creative the bank or the lender is getting, you're going to pay for it, right? DSCR would be a great example.
Yep.
Nowhere else they don't care about your credit, or they don't care about your income. But now you see the terms on those loans. And while they're a great tool when needed, you avoid them if you can, right? So the more risk the lenders take, bank statement only would be considered higher risk, certainly for the lender. So the terms, again, go downhill quickly. But that is not a product that we offer, unfortunately. So we would need tax returns.
Okay, that's very good to know. Let's talk about, are there any, I guess, limitations or restrictions or anything like that for your program?
Restrictions. Well, I lend nationally. I can do, any Fannie Mae or Freddie Mac back loan in all 50 states with no exceptions, no problems. As far as lending from our portfolio, which is the most pertinent product that we have, that's the one that I've been talking about. For that product, it's done nationally, although there is a handful of states that I do need to get an exception in order to lend in. And maybe we can drop that list in an email or something to the people who attended the call, and I'm happy to talk through that with people. But again, I can still get it done. I just need an exception to do it. And a lot of times that comes down to the borrower itself, strength of file, stuff like that. Other than that, restriction wise, and this would be the same anywhere. So if you're trying to buy a second home in the same market, that is not necessarily achievable. It is not impossible. I've done it personally, and I've helped do it. There's like the bigger and better concept. You buy something, say you bought something in, Asheville, North Carolina area. You bought a 3-bedroom, 2-bathroom, 1,400 square foot cabin a year and a half ago, and now you want to buy a 4.4. right? If there's been a little bit of time, it's not 3 months later. It's been maybe a year. We might be able to sell that as a second home, right? The first one just wasn't big enough. The way I did mine was the first one we bought in Florida was a condo. Bought it as a second home. And then about 9 or 10 months later, we were able to buy a single family as a second home, just only about a mile away. And the argument was we decided we wanted our second home to be a single family with a private pool and not a condo. So if it makes sense to the underwriter, you can sometimes make that work. But I've had people where they wanted to buy like the same kind of exact house, like 3 doors down, like that, in the same market. That's not gonna cut it. So that would be I guess a quote unquote restriction. Obviously you can purchase them as an investment property. Interest rates a tad bit higher and down payment is higher, of course. Otherwise, no other, restrictions that I would think would be really noteworthy.
Okay. And from this is not necessarily like with the products you're offering, but I'm hearing that, as of today, let me just claim this before, we get in trouble. As of today, some of your rates are just, incredible. Do you mind, can you share like some of the general rates that you have going on right now?
Sure. So our jumbo rates and the new jumbo loan limit is $726,200. So if you're borrowing more than $726,200, you're a jumbo loan. Our jumbo rates are actually better than our non-jumbo rates. They're both good, but the jumbos are significantly better. And I'll give an example of that. The other thing, and this is a nice little niche we have as well, is that even if you're not jumbo, but you are buying a new construction property, okay, so you're closing on a build that you've been, building in the Smokies for the last 18 months, or you're buying a spec home that a builder just finished up or something, rates run the same as jumbo, even if they are not jumbo. So as of today, probably the most popular product right now that people are kind of running to is our 10-year ARM. All right. So that's a 30-year amortization interest rate fixed for the first 10 years. And if that is a jumbo loan or a new construction property, that's 5.75% today with no points. Okay. Wow. If that was a non-jumbo and it was not new construction, so that would be 6.75% today, but again, still with no points. Okay, we also have a 15-year ARM. And again, you're talking 30-year amortization, rate fixed for the first 15 years. We're the only lender, at least that I know of, that has that in the country. And it makes people who have done 30-year fixed their whole life and aren't really used to ARMs a lot more comfortable. 15 years of fixed rate, especially on a second home or investment property, is an eternity. Those rates run about 1/4 to 3/8 higher than the 10-year, but still pretty good. You're talking, high 5s to low 6s on the jumbo and new construction, high 6s to very low 7s on the non-jumbo, non-new construction.
Wow. That's yeah, that's great. Man, those are really good rates. I've been
subject to change without notice on a daily basis.
Yeah, yes, okay. Yes, they do. So I mean, who knows? Like a couple months, it could be terrible rates or amazing rates. But yeah, they do change. And it's important that you reach out to Brian to get the most updated rates possible. But comparatively, what I know of from other lenders, that those are very attractive rates. I know you're working with clients. I know someone in Montana. I know a lot of people in North Carolina who are using you. Yeah. Someone in Ohio is using you and your program. What other states, just from a general perspective, right now, are you really seeing investors using your program or really going to?
Sure. Definitely a lot of business in North Carolina. working with Tyler Kuhn and his team there. They're great, and people are flocking to that area. Doing a lot of business still in the Smokies. People still love the Smokies for sure. Obviously, Florida's big, just about in any part of the state, pretty much, whether you're up in the Panhandle or down in Southwest Florida, where I'm at right now. Florida's hot for sure. Some other areas that are still really good, but maybe have cooled a little bit, like Broken Bow. Still doing some Broken Bow. A little bit of spattered through the Midwest, around lakes and stuff like that. But I would say the somewhere that Smokies on the Tennessee side into the Carolina side of, and then in Florida are super hot right now.
Gotcha. Okay. Okay. So, as a short-term rental investor yourself, are you, just out of curiosity, are you looking to expand your portfolio, and potentially where are you looking?
I am, and I just thought of one other spot. So I'm looking in the Smokies, and I'm looking in the Asheville, North Carolina area, and I'm also browsing the Bourbon Trail in Kentucky.
Ooh,
so
right.
I've heard a lot of chatter about that area, and bourbon certainly is exploded in popularity. Mm-hmm. And I think I learned recently that 98 or 99% of the world's bourbon is made in Kentucky. So that's an area that I am looking at a little bit, along with, like I mentioned, the Smokies on both the Tennessee and North Carolina side. And I was looking in Florida because I'm here all the time, and we love Florida in general. But
sure, what parts of Florida?
Well, I'm in Southwest Florida, Marco Island specifically, just south of Naples. Okay. And we do well here. We have 3 here, 2 condos and a house here in Marco. So it's, for me, it's just kind of going with what I know, because we're here 6 months a year, so it's easy. We know the area. We're able to make smart decisions, and I think that's important. We did have a hurricane scare back in early October. We caught a pretty good piece of that hurricane, but everything's good now. And that did give us a little bit of, because 3 of our 4 are here, and we've, every time we bought one here, we said, well, the next one will be somewhere else. The next one will be somewhere else. But we kept buying here because, again, we know the area and we feel like we can make good decisions. But then when the hurricane hit, we got a little nervous and thought, maybe we need to concentrate on some diversification. Otherwise, we could, kind of almost all of our eggs in one basket. So there's that kind of push and pull on, whether to go into a new market or continue to grow where But I think at some point we need to move on to different areas. So we're trying to do that now.
Yeah, well, you got a great.
What about you? I think are you in a short-term rental right now? I saw an arcade.
Yeah, I actually am. So I thought maybe... I am. I'm in Destin. I'm in a short-term rental. I'm in a friend's short-term rental. So okay. Snowbirded, because I originally live in Buffalo, New York. So need to get away for a month. Okay. So, yeah. And I have properties all in and they're all up in New York area. But yeah, I'm also looking to my next one, and some deals I'm working on a deal in Branson right now. I'm helping some clients in Hot Springs area, Hot Springs, Arkansas. I'm not sure if you've done any deals there yet. And then always North Carolina. Something's always going on there. It's a great market to invest in. And so, yeah, I think these are all good markets, especially for the products you offer, if I'm not mistaken. So Missouri, Arkansas, North Carolina. So, but yeah, so guys, if you're listening, we're kind of wrapping this up, but if you have any questions, feel free to put them in the chat, and we'll try to answer them as we go. But let me go ahead and put up, before we take any more questions or anything. Brian, this is the best way to get a hold of you for anyone who's watching or later on watching on email. Shoot Brian an email. Brian, is there anything that so what, I guess one thing we touched on, and I want to reiterate for people because they don't do a great job of it, and you'll probably get excited about when I say this, is what information do they need to know? Or, when you have people who come to you that you say they're prepared, what is it that they're prepared with beyond just tax returns? Like, what information is good for an investor a potential investor to come with you and say, Brian, I've got a deal. I've got my tax returns. What else can they bring to you that you say, okay, we've got enough here to kind of go forward?
To be honest, Kenny, while I love a prepared client, I don't need them to be that prepared. I can handle it. I can walk them through, let them know what I need. We have some really high level discussions. So I talk to people who are super prepared, people that I learn things from all the time when I'm talking to other, short-term rental owners and buyers. And I talk to people who are far less prepared, and I add some value there. So, obviously having a good idea and a good handle on your income and your assets and situation for sure. But, if you feel you're not prepared, don't hesitate to still reach out. We can get you prepared, very easily. So.
No, that's great to know. I mean, I think calling lenders can be intimidating. A lot of people, so I consult with some people and I always ask, what's your budget? And they're like, well, we're thinking between this, and they're telling me how much cash they have to put down on a property. And I'm like, well, have you spoke to your lender yet? And they go, well, we haven't found one. And I'm like, you kind of need to do that before we determine what you can actually afford. And it can be intimidating because they might not feel as prepared as what I was mentioning. So it's good to know that, someone can reach out to you because, one, you understand what it costs and to own and manage and run short-term rentals. And then two, you can educate them from the lending perspective. So we appreciate that. Brian, is there anything else as we kind of wrap up here, is there anything else you'd like to add or include before we close out?
You mentioned, it's funny you mentioned, kind of pinpointing their price range or whatever. One of the funny things about short-term rental investors is when I talk to somebody about a primary residence that they want to purchase, they're very specific. I'm looking for something between $600,000 and $700,000. Most of my short-term rental clients, when I ask them for a price range, it's like $500,000 to $1.2 million. Basically, it's just whatever is going to make the numbers work. So I kind of get a kick out of that. But no, I don't really have much more to add on that. I would say, it's been transitioning my business over the last couple of years into probably 80 to 90% of where 80 to 90% of my clients are short-term rental investors has been a real nice transition. The conversations that, and I think it goes both ways. I do believe that a lot of my clients really value the fact that I am a short-term rental investor as well. And we have a lot of incredibly good conversations where, I learn from them and they learn from me. And it's, I do believe I can add a lot of value there, and it makes it more enjoyable for me as well. I much prefer to talk about STRs than, boring mortgage stuff. So.
Yeah. There's always a great story or something to share with an STR. So I totally get it. Thanks. Well, Brian, thank you so much for being on. Anybody who's listening or watching, you can reach out to Brian at brianbockholdt@yahoo.com. And reach out to him. He'll contact you back and help you out whatever your situation is. He'll answer your questions. And if you have questions about this video, reach out to him as well, and could just connect. Yeah, thanks for being on here, Brian. We appreciate the information, especially with being a new year and everything, and things have changed. And so it's good to hear what
Sure.
kind of the outlook is and how things are going. So thank you so much. And I appreciate you being on here.
Well, I appreciate the opportunity, and it was nice talking to you, and I'll be checking the email.
Yep. Sounds good.
All right. Thank you, Kenny.